A lot of investors are unfortunately learning that valuation matters as they look at Docusign stock drop about 30% in the after hours, around 50% from its all-time highs just a few months ago. And I'm starting to wonder, is Docusign, which has done extremely well during the COVID era, is Docusign finally cheap, especially after you've seen such fantastic growth in their underlying business? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. Let's dive into what does Docusign do, a quick recap, and my thoughts around the current valuation, especially as the stock is down so much in relatively short time. So in full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in Docusign. And so Docusign, DOCU is the ticker, is a really impressive company. They're the number one in the world for e-signatures with over 1 million customers. While this might sound like a mundane or even trivial functionality, the e-signature, it actually plays a really critical role across many different industries. And management thinks the market opportunity is huge, around $50 billion. The reality is that the age of pen and paper contracts, it's dead. And the e-signature is a dramatic improvement. This can range from new hires paperwork, sales orders, event registration, legal contracts, purchase orders, really any contract of importance where you want to track its progress. Ultimately, the value of an e-signature is actually a lot more than that, as it's cheaper, faster, and better than the historic manual process, which has significant pitfalls like scanning things in and audit functionality, seeing when, making sure people actually filled out the whole form and, where do we save it, save this file. What gives Docusign a lot of optionality beyond just this e-signature is that they're layering in a lot of significant additional functionality. For example, they're also the leader in contract lifecycle management, which is helping to facilitate negotiation for a deal, let's say, or tracking red lines with attribution. Also analytics. Let's say you're a major company that has tons of contracts. You can see, the vast majority, 50% of our contracts, let's say, have 30-day agreements, 20% has, let's say 2-week agreements. And so you can quickly analyze the contracts that you have. And also this notary function, which is relatively new, and honestly, I think is fantastic as it's enabled by secure video conferencing. So you don't have to go out, meet a notary in person. I just love the fact that this is a new functionality, the notary function. With this valuable suite of subscription offerings, they've posted very strong net dollar retention rates. Where you're effectively looking at their prior cohorts spending 20% more year over year. So 121% net dollar retention rate means all the existing customers, if they didn't get any new customers this year, their prior cohorts were still spending. You still would have grown by 20% just based on all the old customers spending net 20% more. And they've also posted fantastic growth and rapidly became a Wall Street darling during sort of this COVID era. I mean, you could see how their revenue growth dramatically accelerated from effectively the business doubled in 2 years from $700 million in fiscal 19 to $1.5 billion in revenue in fiscal 21. As COVID accelerated their business due to stay-at-home or remote work really anywhere in the world, their valuation multiple expanded by more than 3x from around 10 times sales, which you can see back in 2019, to 30 to 40 times sales more recently. And that, in all honesty, that's a real mistake. And this is unfortunately the era where a lot of folks start getting excited and they start saying, well, valuation doesn't matter. This is such a great company. And this is, in all honesty, this type of setup is a classic mistake. When you see a business start accelerating significantly and then it gets this valuation premium, that's the mistake. Because in the future, are you going to be able to grow as fast as you are when you benefit from COVID? No, your growth rates are probably going to be lower after you get that COVID bump. You get this initial acceleration because of COVID, but then you go, okay, so your business accelerates, let's say from 30% to 50%, as we've seen. But you know what? After that starts to subside, maybe you go back to baseline of around 30% growth. And that's really the reason why it's like, if you're going to want to justify this valuation, you're also going to need to see sustained high growth, not just a one-time accelerant. And I'd argue COVID was a one-time accelerant. It's not leading to a sustained, let's say, 50% growth annualized in the years ahead. And that, unfortunately, creates a real risk that they reset back to where they were, potentially even lower than where they were, because the reality is they're bigger. You get the law of large numbers. It's harder to maintain really fast growth. Previously they were growing around 30-40% a year. Then they accelerated a bit, quite a bit to COVID. And then stockholders were like, hurrah, look at the valuation multiple expand by 3 to 4x. And they're like, yes, this is great. This is what's really driving the stock price. What's really driving the stock price during this time is that folks were willing to pay more for it. And that's appearing to be a big mistake, especially as you see this 30% drop in the after hours, about 50% from their all-time highs. Now the stock is down, and why is it down? And it's because their third quarter billings decelerated to only 28% year-over-year growth. And management, effectively said, hey, this is because we're seeing a post sort of pandemic high. Like last year, their billings were growing 63% year-over-year. Now, this was during the height of the pandemic. Critically, I'd also argue their sequential billing, so comparing third quarter versus second quarter, also declined 5% versus last year's sequential 8% increase. So folks really did see a step down in terms of that growth rate. And then Wall Street always focuses on the latest data point. And the data point of 28% growth is really, a sort of like, whoa, what's the right multiple to value this at? And arguably, I would say 28% growth, you might be looking at, if folks start thinking, oh, that means they're going to be growing around 20 to 30% in the years ahead, maybe 35%, if they're able to reaccelerate it. If they're going to be around that level of growth, you might actually see this closer to under 10 times sales. And that's from what I was just showing of like over 40 times sales. So what are my thoughts about the valuation? Is it actually now compelling now that it's sold off about 50% from its high? First, quick plug. Well, if you're interested in following along with my personal financial journey, go to unrivaledinvesting.com, where each month I call out a potential multi-bagger, as well as my personal portfolio. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. So once again, if you're interested, go to unrivaledinvesting.com, click join the journey. And if you enjoy videos like this, trying to find unrivaled companies, please make a point of hitting that thumbs up, hit that subscribe button. So thinking about DocuSign's valuation, let's first look at their guidance, where DOCU is the ticker. They're guiding to very strong growth this fiscal year, fiscal 22, 46% subscription revenue growth. I'm going to talk about why subscription is really the key part that you want to focus on, not their total revenue. And they're guiding to really juicy non-GAAP operating margins, around 20% operating margins, non-GAAP operating margins. You can see here, really juicy non-GAAP gross margins. So they're saying, look, we have really nice profitability of around 20%. The problem here is that, look, you always need to peel back a layer to understand what's actually going on. And the reality is that the adjustment here, this non-GAAP adjustment, is it's almost entirely from stock-based compensation, which is a very real and dilutive expense. You back this out and they're actually operating at a small loss. And so it is definitely something to consider. So as I'm thinking about DocuSign's valuation, I looked toward their subscription revenue, as I mentioned a minute ago. This is because about 3% of their revenue is from professional services, which is run at negative gross margins and can be viewed as a form of customer support. This might be a form of onboarding, a new customer and saying, hey, let's make sure we get you set up properly. And it's effectively a cost to the business. So when you're thinking about it, it's running at negative gross margins, so we really should be valuing it on the subscription revenue. Overall, I like DocuSign and think the valuation is much more reasonable now that it's down about 50%. Based on 45 to 50% growth this year and maybe 30 to 35% annualized growth, it could deliver reasonable returns over the next 5 years. I mean, look, a lot depends on execution. The recent billings was only 28% year-over-year growth, so that does mean they're going to need to accelerate from here. It's possible they do that given their suite of solutions. The stock price can always go way higher or lower than a hypothetical framework that I pencil out. And also, look, they could become, an acquisition target. Potentially, they have a lot of really interesting reseller partners that I didn't even get into here now that the stock's down so significantly. But overall, what I'm looking at here, based on this new sort of reset and valuation, I think it's important to consider what's your growth rate in the years ahead. I'm saying 25 to 35%. That's the range. I'm saying long-term, they're able to get to significant profit margins. That's well beyond, where they are now, because they're effectively around break even now. This is saying, hey, yeah, let's factor in stock-based compensation as a realistic expense, which it is. And then, let's actually get to those really juicy profit margins. I want to see real free cash flow, not purely driven off of stock-based compensation, which is the key element of why they're free cash flow positive. And so looking at this, thinking, let's say 30, somewhere around the 30% profit margins, 25 to 35% growth rate, let's say 25 to 30 times earnings multiple 5 years from now. And that effectively gets you to around break even to around 150% upside. That's what I'm looking at here. Why this, 25 to 35% growth rate? Well, if you look at pre-COVID, they were growing in the high 30s. So, maybe I'm being too conservative here. Maybe I should say really 30 to 40% growth. That is a question mark given that they've launched new solutions. We'll see. Either way, I'm still saying, I think this business can grow by 3 to 4 times over the next 5 years. So that is still quite a bit. And it does, this does effectively factor in that they're going to accelerate from their most recent quarter where they said, hey, our growth rate decelerated to only 28%. Despite this recent share price collapse, I'm actually not ready to pull the trigger as they have a lot of execution to prove around this growth and margins. At this point in the cycle, if I'm looking to buy a stock that needs to prove their margins like they are, honestly, I'm just going to want a lot more upside potential than 150%. I think I need to make a whole separate video about this because, in all honesty, things have just changed dramatically in the last few weeks where I think investor sentiment and people need to understand the liquidity dynamics for businesses like this where, you can't just value something saying, hey, give it full credit to future margins that they're nowhere near delivering. We might be in a new environment where you actually need to prove your profit margins. And if you're not, then you're going to need to give, more upside potential. So I'm looking at this and I'm saying, even at this 150% upside potential, a lot of upside downside. If they don't execute, then downside could obviously be a lot worse. And, for example, I called out exclusively to my Journey subscribers, a company in a similar situation where it's like, you need to prove your growth. You need to prove your margins. They are growing very, very quickly and honestly trade around a similar multiple to what you're looking at here, but it's this potential multi-bagger is growing much quicker. In that situation where it's like, you need to prove a lot. You're not generating significant free cash flow. Then I want a lot more upside. And that one, I think has like 600, 700% upside. And if it's not something that needs to prove itself out, then I want some sort of valuation backstop, like significant free cash flow. I'm like, this is relatively cheap. If you are a Docusign bull and you feel like I'm missing something here, and maybe it's like, hey, you time to load up the truck and you're like, you've been waiting for this price around, 160s or something to buy it. I definitely love to hear it. If there's an angle with Docusign that you feel like I'm missing that potentially makes it, worthwhile, or you think that the potential for an acquisition target for them becoming an acquisition target is much higher than I'm thinking, definitely leave a comment below. And thanks for tuning in. If you enjoyed this video, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much.